Today we're going to go through what in my opinion is the easiest and best investment that you can make today that will set you up for success for years to come. And that is through index funds. In fact, Warren Buffett recommended that the average investor should put their money into low-cost index funds. Now, when I first heard that, I was offended. I'm like, me, average? No way. But in reality, to beat the index is one of the hardest things to do. In fact, Warren Buffett had a challenge that over a span of 10 years, if anyone could beat the market, he would reward them $1 million. Guess how many people won that reward? 0. And that's because the overall market and the index beat every active investor out there. And so if you want to beat out most investors, the best thing you can do is to be average. That's what you want. Now, before we get started, one of the biggest areas of confusion is the difference between an index fund and an ETF, because technically you can buy both, but there are a few nuances between the two that I think would be helpful to clarify. To keep it simple, an index fund is generally purchased through an investment company like Vanguard, has a minimum amount required to invest, and generally is a little bit more difficult to buy and sell. Like, you can only buy it like once a day and sell it once a day. Versus an ETF, anyone can buy through any investing app like Wealthsimple, IBKR, E-Trade. There's no minimum required, and you could trade it, buying or sell it, as many times as you want throughout the day. So while in this video, I may be using the terms index fund and ETF interchangeably, I'm mostly referring to ETFs that are easier to buy and you can buy at any time. And don't worry about needing to buy one that's going to do better, because theoretically both should perform exactly the same. So now that we've gotten that out of the way, let's dig into the one ETF that you need to build long-term wealth. And so without further ado, that ETF is VTI, or the Vanguard Total Stock Market Index Fund, which essentially gives you the full power of the US economy, because that's what you will be investing in. And what exactly does that mean when I say the full US economy? I mean, when you invest in VTI, you're investing in over 3,000 companies. And because VTI is market cap weighted, it means you're going to be investing in small and medium caps, which is really good because it gives you exposure to those small and medium companies, versus when you invest in something like the S&P 500, that's only the 500 largest company. Now, because VTI is market cap weighted, it means even though you are invested in those smaller companies, the bulk of the investment is going to be in those bigger S&P 500 companies, which is really great news because it gives you more of that steadiness and less volatility that you get with the smaller companies. So you might be thinking, why VTI over SPY, which is the S&P 500? So let's take a look at some of the similarities and differences between the two. First, SPY is mostly focused on the 500 largest companies. So that's like Boeing, Apple, Microsoft, Google, Nvidia. While VTI covers all of those, it also gives you exposure to smaller companies. And this is actually really great because think about a company like Amazon. Amazon started off as one of those small companies that wasn't in the S&P 500 because it was a tiny small cap company. So if you were invested in the S&P 500, you wouldn't have had exposure to Amazon until many years later, versus if you had invested in VTI, you would have had exposure to Amazon from the day it went public in 1997. So by investing in VTI over SPY, you get to take advantage of being exposed to those companies like Amazon and really experience the growth from the beginning. And the exciting part is the next time the next Amazon comes around, because you're in VTI, you'll already be invested in that company. So you don't have to worry about looking for the next Amazon because you're already purchasing every company in the US. And VTI also includes all the companies in the S&P 500, so it gives you that good stability knowing that established companies like Amazon, Google, Apple are the bulk of your investment. So how has VTI done versus the SPY if you invested in it? Well, over the past 5 years, SPY has actually outperformed VTI, 93% versus 88%. And the reason for that is over the past few years, larger companies have really benefited, especially in these economic times. And that makes sense because over the past few years, two main themes have been present, and that is the pandemic and a rising rate environment where the Fed has increased interest rates at the fastest rate ever. And in that type of environment, larger companies generally do a lot better. And so that's why we've seen SPY outperform, because it's mostly bigger companies. But here's where things are really changing. Now that we're out of this rising interest rate environment and the Fed is cutting interest rates, this actually is really beneficial for smaller companies because they generally have higher levels of debt. And so as interest rates change, they're a lot more impacted by these rate changes. So as rates come down, that means that these smaller companies have a lot more money to invest back into their businesses and really see them grow. So that's a really exciting opportunity to be in right now. So what are some pros and cons of buying VTI? So some of the pros is that there's a really low expense ratio of 0.03%, which means you keep more money in your pocket or in your investment. There's lower overall risk because you're buying the entire market. So unless the entire market crashes, your investment is safe. And it's easy to buy and sell, just like an ETF. And it lets you buy over 3,000 companies, shares in each one of those with the click of a single button. So what are some of the cons of VTI? One is it's geographically just for the US, like it's just US companies. But I'm going to get to that in a moment because I don't think that that's necessarily a risk, and I'll go into it why. But then the other one is exposure to tech companies. Because tech makes up such a big component of US companies now. Like think about the top 5 biggest companies. It's like Amazon, Google, Microsoft, Apple. Like these are all tech companies, Nvidia, like all tech companies. And so it really overexposure exposes you to that sector. But also I think tech is the way of the future. So I think that's probably where you want to put your money anyways. So digging into more of the cons and details. So the first one was that the geographical nature of VTI being focused on the US. And what this means is that your investment is really focused on how the US performs compared to like China or Japan or Germany, which are other great economies as well. And while that is something to be cognizant of, I think it's also important to remember that the largest companies in the US are also global in nature. Like they don't just serve US customers, and they actually serve people around the world. And that's because almost a third of all revenue from US companies actually comes from outside of the United States. So that's like Tesla selling cars in Norway or Japan, or Starbucks opening up in China, or airliners around the world buying Boeing airplanes. Like all of these global customers are buying US products, or even Apple, like they sell iPhones and MacBooks, and a lot of their revenue comes from like China. So even though you are investing in US companies, a lot of their revenue does come from outside of the United States. So you're really dependent on the entire world in a way. Like imagine if China stopped buying US products, that would have devastating impacts to the US economy. Likewise, if Germany or Japan or the United Kingdom, any of these countries stopped buying US products, we would be in a lot of trouble. So while you might not be directly invested in global or international companies, in a way, you are, because these companies in the US are global in nature. And there's a lot of word out about how China is the second largest economy and it's going to overtake the US and become the next global superpower. And while that may happen or may not, another thing to keep in mind is it's actually illegal for US individuals to invest in China. So you might be thinking, but hey, I can buy Alibaba shares, which is a Chinese company. But in fact, that's not a real ownership stake in Alibaba. So the way that US investors get around that is there's a holding company based out of some other country which buys the shares of that Chinese company, and then you buy shares of the holding company. Now, what that means is you get to benefit if Alibaba stock price goes up or down, but you don't really get a real ownership stake that you get when you purchase shares and you invest in them. So if you're looking to invest in Chinese companies and want to take advantage of the growing Chinese consumer, instead of trying to invest in Chinese companies through that through that alternative way, instead buy companies that sell products in China. So whether that's Nike or Tesla or Starbucks or Apple, because you're essentially investing in the growth of the Chinese consumer and the Chinese economy. So if China does well, that means these companies will do well as well. And overall, I think the US economy is going to be the strongest economy for decades to come. And I personally would rather be invested in the US than any other country in the world. And then also tech, I think, is going to continue to dominate. While Apple or Microsoft, these companies might eventually go away, I think other companies that get started in the US will eventually replace those companies. And the best part about investing in an ETF ETF like VTI is as Apple or Microsoft lose relevance, whatever the next big Amazon or the next Apple is, you'll already be invested in it and get to take advantage of it as that company grows and get rewarded for it. So that's why I think VTI is one of the best investments that you can make today. And honestly, I think it's the one ETF to rule them all. I hope you enjoyed that Lord of the Rings reference because I've been waiting a long time to use it. And if you're looking to learn more about personal finance or enjoy some more Lord of the Rings puns, then definitely check out some of these videos next.